What's goody fam? If you've been around the market for the past little while, I'm sure you'll remember the drama that went down with Kakao Pay that led to the tumble in its stock price and in the stock prices of the Kakao family. It also led to a lot of general anger from the investing public at large. Today we're going to be talking about one of the factors for why that happened. You're watching Sekider, and today we're talking about something that has really been plaguing our market ever since its inception: stock split-offs. Now before we continue, we'd just like to remind you that this channel is meant for general education purposes only and isn't meant to replace the legal or financial advice from a paid professional. When it comes to investments, it's always healthy to take everything with a fair bit of skepticism regardless of the source. Whenever you hear anybody talk about a stock, whether it's us or somebody else, it should always be standard practice to assume that they have some position on the stock. And for that reason, nothing we say here should be taken as a basis for investment, and you'll have to do your own work and thinking before deciding whether or not taking up a position on any stock mentioned here is in your best interest. Want to know how? Well, if you scroll down a tiny bit and hit the like and subscribe buttons, we'll do our best to help you figure out how to figure out this game for yourself. And that being said, let's get to it. Alright, so before we dive in, let's roll it back a few weeks to the end of December, beginning of January, which is when we saw Kakao's stock really eat dirt after massive sales of Kakao Pay's stock by executives, including but not limited to their CEO, who had been slated to be Kakao's next CEO but resigned over the whole debacle. This was just another point of controversy that came after a year that left many people questioning the integrity of the firm's leadership. But in this specific situation, it raises the question for why this is even an issue in the first place, right? Like, they weren't subject to lockup, and it was entirely in their rights as shareholders to sell out of their positions whenever they see fit. So, what's the big deal? Well, let's start with a few small logical jumps. First, massive sell-offs by any large shareholders naturally create sell-side pressure, which can and will lead to and or exacerbate an overall drop in stock's price. Makes sense, right? If you have a lot of people selling or you have a bulk being sold, then it creates negative pressure on the price. More importantly though, we have the second point. As investors, it's always important to consider the concept of skin in the game. Now, this concept is one that was popularized by Nassim Taleb, who applied it to investing in his book by the same name. Generally, if you see executives of a company buying large amounts of stock on the market, increasing their skin in the game, aka their exposure to the stock price, aka consequences or benefits of the company's performance, one may assume that they know something about how the company will improve in the future that's encouraging enough for them to increase their own position. Additionally, the more skin in the game an executive or CEO has, the more likely it is that they'll work harder and be more diligent about doing well and providing returns for their shareholders, since they themselves hold such large stakes in the company. Conversely, when you see executives in a given company selling their shares, it may not necessarily mean that they're getting ready for a drop in the stock price, but it's easy to read it as an indicator that the stock price is, to the best of their knowledge, not going to be getting significantly better in the near future. Now, these are of course issues with any instance of any executive selling their shares at any point. And it really does kind of suck because in addition to potentially creating negative opinions about the company, it also leaves small investors like the rest of us who don't have that much capital or influence over the companies holding our dicks while holdings lose value, simply because executives of the business decide that they'd rather cash out. Now again, none of this is illegal, but it is a bad look for a company when their executives just go out of their way and leave minor shareholders in the dust. And that's kind of one of the big problems with what happened with Kakao Pay, but the bigger issue with Kakao Pay really reaches back into the history of the market as well as the current state that it's in that Kakao Pay IPO'd as a split-off rather than a spin-off just before the sell-off. Now, we already went over the difference between split and spin-offs in a past video, but what's really important to note is that when a spin-off occurs, current shareholders of the company receive a proportional amount of compensation upon the creation of the new company. In some cases, this is just a provision of stocks of the new company where any shares sold at the IPO would be additional to the shares that were already distributed to existing shareholders of the parent company. So for example, imagine you own shares of tire manufacturing company A. Company A at some point expanded into the furniture business, which took off, but now the execs and the board of directors decided it would be better to spin off that furniture company. Doing so would let the furniture part of the company continue to grow and innovate on its own while the parent company focuses on their bread and butter, which is tires. Naturally, as the furniture company is no longer wholly owned by Company A, its impact on the earnings and value of the parent company would fall significantly. Thus, Company A decides on a 10-to-1 share distribution, meaning that for every 10 shares that a shareholder has of Company A, they would be awarded 1 share of the new company. In this case, you, the shareholder, would not only maintain your current shares in Company A, which, for example, let's say you have 100, you would also get 10 shares of Company B's furniture stock once it debuts on the market without doing anything. Now, what you would do with your existing shares would be entirely up to you, but at least in the case of spin-offs, you get what you paid for, or at least you get a little bit of compensation. Split-offs, on the other hand, do essentially the same thing but without distributing stock or compensation to existing shareholders of Company A. And this is where the problems lay. Because while split-offs are rare in markets like those in the US due to tight regulation that protects small shareholders, there aren't the same such protections here. Thus, instances of old-school crony capitalism occur where shareholders will buy up stock in one company because one particular division is excelling. Then the company they own announces their intention to split off that division, immediately and substantially devaluing the shares that existing shareholders have. In that case, they're incentivized to sell, knowing that the business they currently own won't be as profitable once that part of the company splits off. And while this is, again, entirely legal, it's discouraged and highly regulated in many markets, as it can be seen as being unfair and violating the rights of minor shareholders. For executives with stock options in their contracts, however, the IPO of their business can prove lucrative if they choose to exercise their rights and sell their shares. And this creates an unfair tiered system whereby executives and major shareholders have a way of creating massive amounts of value for themselves without providing any value or any opportunity for smaller shareholders to benefit. The fact that Kakao Pay's executive sell-off came not 1 month after the company's IPO makes it even more of a slap in the face for small-time investors who hold both Kakao and Kakao Pay, because they had to pay for Kakao Pay in spite of already owning the parent company's stock, and were not given an opportunity to profit from it, and this has been completely reflected in the conglomerate stock price as of late. Let's be clear though, the issue of split-offs isn't limited to this one instance. They've been so common historically as to be considered a feature of our market at this point. We just saw a massive split-off in the form of LG Energy Solutions IPO. In this case, investors who went in heavy on LG Chem stock when it took off in 2020 on the back of the firm's battery deal with major domestic and international EV producers didn't receive a single stock of LG ES when it split off from the firm. And this is in spite of the fact that that would have been a main factor encouraging their stock purchase in the first place. Even for investors who'd been clued in about the split-off early, or who anticipated it once LGES became its own company within LG Chem, it really does feel unfair to be forced to sell a share in a company by the company itself. And in addition to this now, we're seeing something similar occur with eMart's planned IPO of SSG.com, their online sales arm and a large driver of their profits. Now, while that IPO may be put on the back burner as the online commerce sector is in a bad way at the moment, the fact still stands that any future split-offs will inevitably lower investor value without any recourse or compensation. And that leads to the question, what is being done about this? Well, while the FSS's chief recently stated that they would be looking into ways to balance the playing field for smaller shareholders by improving the split-off system, and we've seen support from both the ruling and opposition parties with regards to some type of reform, we're still ways away from any material change in this regard. Additionally, we know from history that once changes to regulatory laws are announced, firms often make sure to take advantage of the existing rules while they can, and for that reason, it would be best to tread lightly around companies with such plans in the future. Alright, we went long today. That's it for me. I hope this brought an issue to light that many may not have known about. If it did, please do me a favor, hit the like and subscribe buttons below. Otherwise, we'll catch you in a minute. Peace, fam.